The U.S. Federal Reserve has announced another big hike in interest rates as monetary authorities seek to keep a lid on inflation. Consumer prices in the world's largest economy are going up at their fastest rate in 4 decades. In response, the American Central Bank has raised its benchmark by 75 basis points for the second consecutive meeting. Rates set by the Fed influence the amount that banks charge for all kinds of loans. These include credit cards and mortgages for consumers, as well as financing for large corporations. The goal is to make households and companies spend less to stabilize the price of goods. And according to the Fed, that'll lead to slower economic growth. But the White House is confident the U.S. can absorb that adjustment without jeopardizing the U.S. economy's long-term prospects.
This process is likely to involve a period of below-trend economic growth and some softening in labor market conditions. But such outcomes are likely necessary to restore price stability and to set the stage for achieving maximum employment and stable prices over the longer run.
Right now, we're seeing that strong labor market with about 400,000 jobs that have been created each month. We see unemployment at 3.6. There was the state unemployment numbers that came out last week with 21 states that are at 6% or lower. And so the way that we see is that we are not currently in a recession or a pre-recession. And look, we're going to let the Fed do its business.
Now, earlier, I spoke to Russ Mould. He's investment director at A.J. Bell in the UK. He gave us his reaction to the Fed's latest move.
Yeah, but it's interesting. The stock market sort of interprets it as if the Federal Reserve may start to slow down its rate of interest rate increases because share prices jumped very strongly in the US overnight. But if you listen to Mr. Powell, the Fed chair, he still seemed quite determined to make it clear that inflation is the Fed's primary concern, not necessarily the economy, definitely not share prices, but inflation, because that could do even more damage further down the road. The market is pricing in more interest rate increases, but it's also starting to price in interest rate cuts for 2023 because of fears over a US recession.
Right. So is the US Fed moving too late? Because there were already signs that inflation was going up. Maybe they should have moved earlier, and maybe these adjustments need not have been this drastic. So what's your take on that?
I think the Fed has admitted it's probably moved too late, if not publicly, certainly by actions. It's abandoned its story that inflation would be transitory, and the fact that it's raising interest rates so fast means that it does feel it is behind the curve, and in the end, inflation is running at more than 4 times its official target. So I think it did move too slowly on inflation. What there is a clear risk is that it is now moving so fast with, say, American corporate debt, American government debt, and American consumer debt also high. They will only take relatively small increases in interest rates to start to slow the US economy down. And the Democratic Senator Elizabeth Warren, she was arguing yesterday that the Fed is in danger of causing a recession. So there is some political pressure being brought upon the Federal Reserve, particularly because this is a midterm election year.